Hello, everyone. Welcome to Multifamily Investing Naked Truth. I'm your host, Corey Spurley, joined by Michael Bug from Saskatoon. Hello, Mike.
Hey, Corey, how's it going?
Excellent, fabulous. Nice rainy day here in Kelowna. We're doing a follow-up on our YouTube video we hosted a few days ago about the Bank of Canada, raising interest rates. And this has sparked a large conversation on underwriting multifamily deals. Now, Mike and I are in the middle of underwriting a deal right now, and it has not been the easiest thing. So we're going to talk about that, how things have changed with underwriting, and especially 2023. Before we get into any of that, I'm just going to very quickly talk about the 5 steps that I use to underwrite a deal. Now, I've refined this over the last 20 years of investing to a point where I'm pretty good at filtering down properties. But if you're not familiar with commercial, these are the steps that I do. So first, I do a pro forma analysis. I have some quick filters that I can tell if a property is going to work or not. But if I find a good prospect, I take a look at the upside and if it's worth, further investigation. Now, the second step is I do a rental survey of the area. So just because I have a rent roll doesn't mean, that's what the neighborhood can support. The rents could be higher or lower. So it's very important, at least in non-rent controlled areas like Alberta that we invest in, that you carefully survey comparable buildings to what you want to buy. So the third step is to get a loan opinion. Now, I say sooner rather than later, you want to get a qualified commercial mortgage broker on your side that will underwrite a deal before you make an offer. One of the most common rookie mistakes is to get a building under contract, get it under contract, and then go to the mortgage company for a loan and realize you can only get 60 or 50% loan to value. That happens a lot. Okay, so get a loan opinion. Fourth is get a property manager's opinion. Now, along with your rental survey, a lot of property management companies, they're also owners. They know what the values are. So that's another layer of diligence. And finally, step 5 is I always run my deals past multiple other people, investors that are sophisticated, hopefully more sophisticated than I am, to give me that final level of reassurance. So those are the 5 quick steps to underwriting a multifamily deal. Mike, is there anything you want to add to that, or did I miss anything?
I'll just add a few comments in there just on step 1. The key being your own, right? Like we've talked about this on lots of live stuff that we do. The pro formas that get passed along to us, there can be a lot of massaging of the numbers in there. So, you really have to sort of go and look and grab the numbers, put them into your own pro forma. You can't just rely on what shows up on the fancy brochure. Because there can be a big difference there.
Yeah, especially in terms of vacancy rates and expenses. So we're not going to talk about expenses on this call, they're maintenance deficits. We addressed that on previous webinars. But you want to be looking at expenses now for multifamily, probably around the 6,000 to 6,200 per unit per year mark on a standard walk apartment, where there's all-inclusive rent. So we're going to get into that right now. No time like the present. So underwriting 101. We're going to talk about the challenges. So in previous years, probably before COVID, the number one metric that most investors use was cap rate or capitalization rate, which is basically your return on investment if you were to purchase this building in cash. So you basically take your income, subtract your expenses, and divide it by the purchase price, and that gives you a number. Let's say it's 5% or 6%. So you kind of compare that to the market and to determine how much you want to pay. Now, unfortunately, today, that has become a secondary consideration after the number one consideration now, which after, I don't know how many rate hikes we've had in a row, like 8, is debt service coverage ratio. So the first thing the bank is going to look at is the cushion between what your net income is and your mortgage payments. Now, generally, you want to see about a 30% cushion, 1.3. But with new products like MLI Select, they'll let you stretch that to 1.1. So DSCR, very important today. Loans are being scaled back dramatically. I had one case, one of my students, he looked at a building, a 20-suiter. 3 months later, the loan was scaled back about $400,000 just from the rise in rates. So debt service coverage ratio is going to limit your loan, depending on how much you can stretch your amortization to. But that should be one of the first things you're looking at today in deals. Would you agree with that, Mike?
Yeah, we've seen that move so fast, and that ties in with your step 3 on getting a loan opinion, because you might look at something and say you have a 20% down payment kind of saved up, but that property at that purchase price, you may be needing to put more of a down payment on, and usually I would say, okay, well, that indicates probably the purchase price needs to come down. But yeah, this debt service ratio is kind of dictating everything right now in our acquisitions.
Yeah, and that's not even addressing stuff like maintenance deficits or deferred maintenance. But what we've been doing is we've been kind of introducing a stress test. So in the deal that we're working on right now, it actually checked all the boxes. The property manager said, this is a great deal at the price. The mortgage broker said, hey, I can easily underwrite this deal, 95% loan to value. I ran it past multiple people. This deal's a winner. But having said that, we still stress test our deals just because it qualifies for 5%. I think you should still stress test your deal around 7%, just to make sure the numbers still work and your debt service coverage ratio, is still above 1, hopefully, and maybe even 1.2 or 1.3. If it's still 1.3 with 7%, you have a pretty strong deal with cash flow.
Yeah, the thing, you need that cushion. And I know we're not getting into the expense side on this video. The summary is on the expense side of the column, expenses are rising, right? And we can do all that we want to try to do to lower expenses. There's certain things out of our control, right? And so if you have no buffer there, what's going to happen as those expenses start to eclipse, rents are rising, so that's good, but you need that buffer. I mean, you have to survive in this game.
So the second thing about underwriting that we're going to look at is most of the walk-ups, it's an all-inclusive rent. Meaning that as the landlord, you're paying for the heat, you're paying for the water, you're paying insurance, property taxes, everything usually except the electricity in the unit. So what's been happening to multifamily owners all across Canada is the expenses have just been relentless. In particular, insurance, maintenance, R&M is obviously huge, but it's insurance and utilities are the two main ones that come to mind, and property taxes, of course. But with utilities now, the biggest wild card that's really had an impact is carbon tax. Most buildings are, gas heat. I've talked to some owners who say they've seen their heating bills go up by as much as 30%. And this is a very unfortunately poorly short-sighted policy because it's directly contributing to increasing rents for tenants. So I don't think it's doing what it's intended, and it's really hurting landlords.
Yes. I mean, it's wild. We track all of this and you just see year over year, the expenses going up. Luckily now as owners, we are seeing those rents start to take off. So there's some breathing room, but for a few years there, you're really getting squeezed.
Yeah. And I think the only way you can really counter this is, we looking at townhouses where you can offload your tenants, sub-metering in some cases. But I think you just have to really have a large, expectation of what your utilities are going to be. Now, in the past, we used to use 1,500 a unit per year. Now it's like 1,800 per unit per year. But you should actually write in about 2,000 per unit per year when you're underwriting, just to give you that, buffer of safety for your utilities going forward.
Mm-hmm. Yeah. And the other comment I'll just say on that is sometimes people don't run that forward, right? You have to be applying those increases. If you're projecting out 5, 6, 7 years, those expenses are going to rise too.
Yeah. And it's very important to track that. Once you get the building under contract, like once you own it, it's very important that you track, your utilities and, put them in a spreadsheet, have flags that show up if you have a water leak or something, because that can run away, on you in a hurry. So that's something you want to set a budget for annually, and you really want to work hard to keep the bottom line on your utilities. Okay, so let's talk about lending. This is the biggest piece that Mike and I have been dealing with. So when I did most of my deals in the mid 2000s, I didn't go CMHC, right? I didn't want to be dealing with the federal government. It took too long to do a CMHC application. I couldn't get sellers to agree to the terms of an extended close. Nowadays, it's very much, there's two ways you buy a building now. Either you can find a vendor who will actually give you the time to do CMHC, or they're doing some kind of a seller financing. Or I can throw in a third option. There's the BRRRR, which is the value add strategy where you get a bridge loan, which we'll talk about that last. but that's not really the way forward now. So back when I was doing conventional deals, we could do deals 75% loan to value, 3.5%, 25-year amortization, and cash flow quite easily using a 1.3 debt service coverage ratio. My, how the world has changed. Now, under these rates, that same conventional loan, you'd be lucky to get 50% loan to value. Even standard CMHC, they're jacking the premiums on that from 4.5% up to like 6 or 7% now. And to get a 1.3 debt coverage ratio with standard CMHC these days is even tricky. So most small landlords like Mike and I have almost been forced into the MLI Select affordability housing program.
Yes, I'm chuckling as you laid out the conventional, like 75%, 1.3, 25-year am. And I have some of these properties, in smaller markets. And when you get that, it's funny when you look at that 25-year am, like you really can hammer down that mortgage fast. But on the CMHC side, obviously there's lots of benefits there. Some of it does concern me in that, it's kind of maybe inflating where we can go, right? A deal that's like, okay, it doesn't work on this conventional, but la-di-da, there's 1.1 debt coverage ratio. Now it works. So I don't know. It just scares me on the amount of leverage that could be taken on.
Yeah, and I think you're onto something there with inflated prices, especially in Edmonton, because where, every unit is deemed affordable under the the affordable point system. Anything with rents of less than $1,633 is deemed affordable, which I don't think there's any other place in Canada that's like that. Because even Saskatoon, where we also invest, the rents are significantly lower. I think it's like $1,150 or something to qualify for this program.
Yeah, just because the income doesn't register as high. Like Edmonton has the higher income that they base the rents off of.
Now, rumblings are that CMHC is looking at the Alberta situation because there are a lot of landlords who've, I wouldn't necessarily say taken advantage of this program, but they've definitely utilized this program to do the BRRRR strategy and get the rents up to that 1,600 mark. So I think, in terms of CMHC's view of risk for Alberta, I think they maybe see added risk, but we're seeing them pull back, in a couple of ways. First, they seem to be scrutinizing individual deals a lot closer, which is what Mike and I are experiencing right now. And I've heard rumblings of that. So you can fully expect them to look at not just your deal that you're working on, but looking at all the deals in your portfolio. So let's say you own like 5 singles and some multis. They want to see your debt service coverage ratio on all your properties. They want to make sure they're cash flowing. They're going to ask you for property tax statements. They're going to ask you for operating statements, rent rolls, everything to make sure that you are an experienced operator these days. I was telling Mike the other day, this deal that we're working on now, I've never seen this level of scrutiny on a deal before in my life.
It's been a lot. So, I'm not sure when you're airing this, but we're hoping to submit tomorrow. And you and I have been texting each other like over the last number of weeks of like so many documents, going into this file. I haven't even chatted with you since. I chatted with our broker here earlier this morning. And I was like, how are we looking? Is there any red flags? And they were like, no, everything looks great. It's just, we really got to, cross all the T's, dot all the I's. And sort of their thinking on this is when you submit a very complete, very thorough application, it doesn't raise any questions, right? Because you don't want to have them start, poking around. Not that there's anything, that we're hiding in there. It's just, it's going to delay your financing. So it's just, here's one thorough, complete application and let's move forward.
Yeah. And keep in mind, if you're doing a joint venture, especially if you're going into a JV, now most people that do this, they were utilizing the BRRRR strategy. So they're going to Harbor and they're doing a bridge loan, which they may not necessarily have to get their joint venture partners to sign a personal guarantee. And we're going to talk about BRRRRs last. But for the sake of this example, when you're up against tight timelines, to bring in a joint venture partner, in most cases, CMHC is also going to want a personal guarantee from your investor. Now, to simultaneously subject them to the level of scrutiny that, Mike and I have gone under in the past 2 weeks is just not realistic. So you have to think of new ways to JV deals. Either you're going to close on them first. Maybe you do a creative strategy. Maybe you get the vendor to agree to a short-term vendor take, enough time for you to get your investor on board. But definitely going in CMHC with a partner, is incredibly challenging today.
Yeah, they better be organized, right? Like they better have access to all their files, all their statements, quickly, electronically, so they can get them where they need to go, because it's a lot.
And the real wild card is CMHC. So even from the time you submit, I mean, they've been pretty quick lately, even though they've had a lot of these applications. But with the MLI premiums going up on June 19th, I believe, there could be a flood of applications, whether it be new applications, refinances, people trying to get out of their BRRRRs or whatever the case may be. We don't know what the delay is between when we're going to get approved for this. So that's the other wild card with CMHC right now.
Yeah, we'll find out. We're going through it, so we'll know the timeline here.
Part 2 of this video. So yeah, so the biggest change in underwriting. So Mike and I did a deal in 2021 where we actually did a bridge loan. Now, I know a lot of people have done this. You can go in 75% to 85% loan to value, interest only. It's based on prime. It's usually prime plus about 4 or 5%. So back at the time that you and I did this, I think prime was maybe 3%-ish, 2.5%, I think. Today, prime is basically RBC prime is hovering around 7%. So that same BRRRR loan that you and I did in 2021 at 7.5% is probably looking closer to 13% today. So how does that affect the BRRRR strategy today, Mike?
Well, you better be factoring in those interest costs, like those holding costs, like they're just so much higher than what we experienced. And we were catching it. Like we started seeing them month after month, that carrying cost starting to tick up, and we were kind of racing the clock a bit. But yeah, I would be, factoring in, and we could even see more upwards. So I would be building in a fudge factor there. If you are entertaining a BRRRR, in case we see another few moves higher, like you just have to have so much buffer.
And it's not to say that it wouldn't work. It's just that you would have to really have a strong argument to do it. Like you'd have to get it at a significant discount, because there's also going to be a 1 percentage point to the broker, a 1 or 2 percentage point to the lender. Those rates also reset every year. So if you don't finish your BRRRR in 12 months, either your interest rate's going up or you're paying another percent in fees. So there's massive penalties to not do your BRRRR on time. So it's really going to put a lot of pressure on you to get the building up to performing quickly. And now the fact that you're refinancing with CMHC at 5% and not 2%, with those DSCR numbers we were talking about early in the conversation, you might not pull out enough equity to get the money that you think you're going to get to pay off your bridge loan.
Yeah,
it's another real risk.
And remember when CMHC rolled out all their new sort of rate announcements, like premium rate announcements, and they have that sort of wording in there about how they're going to analyze on a case by case, right? And they're going to be scrutinizing more, and they're going to be looking at social outcomes. So there's no guarantee, like if you're modeling your exit at whatever loan to value, whatever amortization, it's not a guarantee you'll get that, right? So you got to have some buffer built in there too.
Yeah, and there's rumblings now that the banks are starting to get tweaky. They're going to start to reduce the risk a little bit. So I wouldn't be surprised if it continues to tighten. So great discussion, Mike. We're at the 20-minute mark. So we'll just do a quick summary on underwriting. It's do as much as you can ahead of time before you place the offer. Try to get as many opinions as you can. Be very conservative with your numbers. Look at the realtor pro forma, but you want to put in your own numbers. And you want to really have a close alignment with a mortgage broker, before you go in. But if you follow these steps, there's a ton of great deals out there. And the best news of all, at least in the markets that we're in, I strongly believe we have several $100s of rental upside, in the next 18 to 24 months. So there's a lot of great deals. You should start investing in multifamilies as soon as you can, preferably with us. Do you have any final comments, Mike?
I do. Totally random. You saw me sneaking off to the side here on my other screen. So I won't say too much, but you and I have been looking around at various deals, and there was one that we did our quick napkin math on, and we're like, this makes no sense. Like it's way overpriced. And I chatted with the broker, and I was like, there's not much point coming to look at it, because we're not really even close on price. And I have an email here, price reduction on that. So the last comment would be, stick to your buy box, stick to your underwriting. If it doesn't work, just pass. You know, you can politely say no and move on. There's always another deal that comes along, and just be patient.
Yeah, and an even better strategy, folks, submit the offer that you think is fair, with the caveat to say, I'm available if the deal collapses. I think I bought 3 apartment buildings that day. Be very confident about your underwriting, and don't be afraid to put in an offer of a value that you think makes sense. This is sometimes the only way to get a deal. You know, oftentimes vendors and their brokers, they have to get whacked a few times with reality before they eventually come back to you, the sophisticated investor, who's eventually going to close on the deal. So
Yeah.
great tips of the day. So good luck, folks. Reach out to Mike and I if you have any more questions. Hope you enjoy the video. Hit the like and subscribe, and we'll see you on the next one.